Welcome to Tax Bites for Expats, the top tax tips you want to know as an expat. The podcast is here to help answer the common queries and concerns expats have when moving to or from Ireland. Complex taxes explained simply. We'll focus on the Irish and international tax issues to be aware of to ensure you save time, money, and stress.
Avoid the hassle of dealing with your bank and transfer online, by app or over the phone or Currencies Direct today. Keep listening for an exclusive offer for Tax Bites for Expats listeners, and thanks to Currencies Direct for their support of this podcast.
Also, a lot of Americans living abroad aren't even going to owe U.S. taxes. So if you're not going to owe U.S. taxes, it's not really a problem. It's only if you're in a case where you may owe.
So this is something we refer quite a bit of work onto you for, and I'd be keen to kind of step it through. So routinely in a consultation, we'll talk with a client and, we guide them through what's going to be taxed in Ireland, when they're going to have to pay tax, how much, and, what opportunities might exist to kind of limit any tax payment to the revenue here. But crucially, what we tell them is that the Irish-US double tax agreement, it doesn't cover state taxes. So when an individual has retained a link or a state residency tax obligation, not my area, I'll pass to you in a second, then we want them to take advice and discuss with their US advisor how and if, and crucially when, that state tax payment can finish, because there isn't a like for like, euro for euro credit from an Irish perspective. What's your experience with guiding clients through that dilemma?
Yeah, so every state's different. Some states do honor the credit for taxes paid in Ireland, some do not. But in general, if you're moving from the U.S., if you're moving from some states, there shouldn't be an issue. You would now no longer be a resident. But you can always change your residency to a state without any state income taxes, for example, Florida or Texas. So we'll often advise clients on how to make that move kind of more on paper, make their new residency Florida and avoid any taxes. And that way, if they are contacted by the state, then they're able to, let them know, no, Florida's my residency, and there's no issue because Florida doesn't have any state taxes. So California is by far the worst. I'll receive letters from California about a client 10 years after we filed. So, for 2016, we'll say you forgot to file your 10 years. Yeah.
They can go back that far.
The federal government is nowhere near that. State government and even local. Sometimes you'll have a local jurisdiction too that may have taxes. But the simplest thing to do is to move your residency forward. It depends on, if you're moving to Ireland for 2 years or 1 year, it's not something you can necessarily do. And if you change your residency in Florida for a year and then move back to California, I think California will know. So in that case, you may still want to pay your state taxes. But for a lot of Americans who are moving abroad, it might be more of a long-term decision. And at that point, definitely changing your residency is the easiest way to avoid any state taxes. After that, we'll look at what state it's going to be and your situation. So even though you may move your residency to Florida, you may move to Ireland, but you might still have income from that state. Let's say you have a property in Ohio, and now you have rental income. So now you could file a non-resident tax return and only pay taxes on the income derived from that state and not, your worldwide income or any income you earn while in Ireland. So this is something that can be very individual because there's 50 states and it depends on which state you're from and how it's treated. But in general, there are some ways to avoid state income taxes as well.
What do you think the other timing issues are that people need to be aware of? So, if income or taxes are assessed or recognized differently between two different jurisdictions, what problems do you encounter for clients when you're working with them?
Definitely partial year. So let's say you moved in the middle of the year, determining when they're paying taxes in Ireland, and then also having a half year of U.S. taxes. So they might file, for a state, you could file a part year tax return. But for the U.S., they're only going to get, credits for half of the year. Determining that, and that's a situation where we really want to know. Usually if you live, and file your taxes year after year, it's easy to predict. But when you're moving in the middle of the year, it's really hard, much harder because, you'll have no idea what it's going to look like, and the tax rates might be lower, and you might not even decide, if you're going to be paying taxes in Ireland, till a later point. So I think that's sometimes a situation that could be more complicated. But in general, your question, what are the timing issues? So obviously the filing can be an issue if your taxes really aren't going to be completed until November, and we want to make sure that they're completed. That's your Irish taxes. We want to make sure they're completed in the U.S. by October. Well, what are we going to do about that? So ideally, we'll try to complete everything on time. Maybe you'll file on October 15th.
Well, we would, I think as well, and that's probably where having two advisors who talk to each other is really helpful, because we have specifically designed it because we have so many US clients that we have like a busy period in April where we do a lot of Irish returns, just get them done. They don't necessarily have to part with the taxes straight away. They can pay them later, but get a final figure across so that you're not having to chase that. And actually, the other point I wanted to mention as well on that, what happens generally speaking, if somebody's in an installment, because I know in the US, you can sometimes pay taxes on an installment basis in advance.
Yeah, that would be if you're usually, for example, if you're self-employed. So if you're self-employed and you're still paying those taxes, then you want to continue paying them. But we're not going to know necessarily if you need to continue paying them until we find out how much taxes you're paying in Ireland. So, right, we might not know. Let's not say November. Let's use October as our deadline. So we're not going to know until October whether or not you paid enough taxes in Ireland or what you would owe in the U.S. So definitely, I would say in that first year of moving, it's good to continue paying those taxes, which should be provided by whatever account you used, or if you filed yourself the previous year. So for the previous year, we would say, okay, this year pay taxes on this this much per quarter, for example, and then you'll just get a refund. So you're overpaying your taxes. Now, let's say that this is a very large amount of money, or if you paid these taxes, then you're not going to have enough money to pay your taxes in Ireland. So that's a situation. Well, then, in that case, maybe it's best don't pay the taxes, take the risk. And if you do owe in the U.S., it should be a much smaller amount because you're paying tax in Ireland. And then even if there's a small penalty on top of that.
And that's a really, really important point, because oftentimes that kind of lends itself to what we say to clients generally, which is if you know you're moving to Ireland and you, for example, are paying on a quarterly basis in the US, for example, then take advice early, because we could, with relative level of confidence, give you an idea of what your Irish tax bill is going to be. That allows you to stop paying in the US, subject to getting the right US advice. It can solve a cash flow problem, because I don't know how quickly the IRS are giving back refunds at the moment, but we've seen it from Irish revenue. Nobody can guarantee you're going to get a refund within a certain amount of time. What are you practically seeing in that circumstance?
Overall, the U.S. is much, much better at giving refunds than a lot of other places. So you can be very confident that if you're owed a refund, you're going to get it. So that's first of all. And then also you're going to get it, most likely pretty fast. It depends on how it's submitted. And, for example, if you submit your return by paper, it will be slower. But if it's e-filed, it would be faster. But you can be pretty confident that you'll at least receive the money. Whereas we'll work with, I know this is in Ireland, but Italy, and you have no idea if you're going to get the money back if they allow amended returns. So something else we might do in terms of the timing issue is file a return knowing that we're going to amend it. So we'll file an incorrect tax return and then amend that a few months later once we have the final numbers. We don't do that a lot, and I don't really like doing that because usually it's the same as waiting. But that's an option in the U.S., and that's something other accountants may do that more.
And I know we've had a couple of cases. They're not common, but it can happen, where we have a draft Irish tax return, which feeds into the US tax return. The US tax return is finalised. You give us a final tax credit, and then we finalise and lodge the Irish return. So that kind of circular, if there's credits being claimed on both sides, because to the heart of this issue, and a common fallacy we see, and we've spoken before about it on the podcast, is there's often a generic belief that, the treaty says I pay tax in such and such a country, and the treaty says nothing of that at all. What it says is it goes through each individual income type and gain, and it allocates taxing rights. So there is no one vanilla statement that covers tax credits. That can obviously be different, cognizant of the US rules, but from our perspective, it's very nuanced how the credits are claimed from an Irish treaty perspective.
I'll mention this, you just kind of touched on it, but the treaty also has something called the savings clause, where basically after whoever wrote the treaty spent all this time writing the treaty, and at the end there's a savings clause which says basically most of it doesn't really apply. So that's a big mistake we'll see from time to time, that somebody will write me a long email, quote all these sections of the treaty, say, okay, well, I don't have to pay tax on this and this and this and this, and have no idea that, how the savings clause works or, what it means. So that's definitely unfortunate. Sometimes if you read the treaty, it seems clear you don't have to pay taxes, but then in the end, it doesn't exactly work, that way.
And now a quick word on our episode sponsor, Currencies Direct. If you're looking for a fast, easy way to transfer money to or from Ireland without the hassle and cost of dealing with your bank, keep it simple with Currencies Direct. Whether you're buying property or require regular currency transfers, Currencies Direct can help you save money. As a special offer for our listeners, when you use the link in the show notes and quote expat taxes when registering with Currencies Direct, you'll receive a €50 one-for-all or Amazon voucher when you transfer €5,000 or more in your first 6 months with Currencies Direct. Registration is quick and easy, and you decide how you transfer 24/7 via their online money transfer service, over the phone with one of their friendly experts, or by using their handy mobile app. Check the show notes or head to currenciesdirect.com to register, and thanks to Currencies Direct for the support of this podcast. So just to kind of round back and touch a little bit more on what you said about investing as an American living overseas, just maybe expand a little bit on this concept of a PFIC. Why can non-US funds or non-US ETFs be a problem for US individuals abroad?
Yeah, the reason is because if they're considered I guess I can't say for sure, but I assume that the U.S. is discouraging investment abroad and would rather you invest in the U.S. But if something is deemed to be a PFIC, two ways in general to treat it: either that you use the mark-to-market election, which means that you'll pay tax on the gains every year, whether or not it's sold. So if you have one fund and it gained in value, you report that as income, even if you never sold it, which sometimes is not a problem. Sometimes it's going to work out to be the same as if you did sell. But let's say you have a fund which grows in value, you pay tax, and then loses value in the future. It can be definitely something which is not as advantageous. But the other method, which is called the excess distribution method, means that you're paying a lot more tax than if it was a normal investment.
Okay.
So that's the reason why you're going to want to avoid you also won't always be able to make the mark-to-market election. There's sometimes a $25,000 exclusion, which means that if you have less than $25,000, you wouldn't have to pay tax on anything. But $25,000 in your retirement portfolio can easily be surpassed for a lot of people and find themselves in a bad situation. So there are lots of ways to avoid this, and that's where we really recommend working with your accountants on that. And we understand it can be very difficult if you are living in Ireland and then you have Irish tax restrictions as well.
It can, and I think sometimes people probably feel like they're hemmed in from every direction. So what would be the practical advice that you'd give somebody who wants to invest sensibly but doesn't want to end up with some kind of a tax monster in the corner at the end of it, given their circumstances have changed?
Well, from a U.S. tax perspective, they can invest in any single share stock, so any company in the U.S. or outside the U.S. So let's say the foreign PFIC, the foreign mutual fund, invested in 10 different Irish companies. Well, you're allowed to invest in any of those companies. You just can't invest in the group fund. So one idea would be just to invest in single shares. Other times we'll work with maybe a husband and wife, and the husband might be American and the wife's not. We might then transfer them to a spouse's name. And sometimes I'll mention that to clients and they're horrified. And other times they think, oh, this is a great idea. But when they are horrified, maybe what we would do is balance their portfolio by putting single shares in the husband's name, and then the other types of mutual funds in the wife's name. So those are options. Other options would be investing in the U.S. So whatever would be allowed in the U.S. from the Irish tax perspective, that's fine. Or other types of assets. So maybe instead of investing, if you're moving to Ireland, maybe instead of investing in mutual funds, invest in real estate. That could be, an idea. If you have a large portfolio or a complex situation, that's when we're also going to recommend working with a a financial advisor. And you and I work with a few together who know this from both sides and are able to help.
It's a bit of an all-party approach, isn't it? There's a few moving parts, which I suppose is just it can come as a surprise to people, but it's probably good to know in advance. What are the key things you say to clients when they're looking to leave the US and they're planning to move to Ireland? What are the generic things that kind of come up? Because I suppose a lot of people listening to this are either in Ireland, having moved from the US, or currently planning a move.
Everyone has their own situation. So sometimes I'll speak with people and they're thinking about moving to Ireland. And then at that point, I'm going to say, I think this might be a little too early to begin planning. Or I'll get they're thinking about moving to Ireland or the UK, Spain, or France, and they want to know what's better for them. Well, at that point, I don't think we're the right person to help you decide where to move. And I think there's also I also would mention to them there's a lot of other factors besides just taxes. But if they have a date, they're ready to move, then I would consider a little bit of tax planning. So in general, the tax rates in Ireland are higher. So they may be in a situation where if they know they're going to be able, they may want to sell. First of all, financial assets, maybe it would be a good idea to go through your portfolio and sell them now, pay the U.S. capital gains tax rate rather than the Irish capital gains tax rate. So that could be a good situation if they do that before they move and before they're taxed in Ireland. Same thing possibly with a house, right? I speak with a lot of people. They say, well, it's going to be easier for me to sell my house once I moved out and moved everything in Ireland, and then I'll just have, the house will be empty so I can have the realtor sell everything. Well, at that point, you might be taxed in Ireland. So it might be a good idea to sell it before, figure out where you're going to live in the U.S. for a few months. But definitely you could save a lot of money that way because you're not subject to taxes in Ireland on that income. And then there's other types of planning opportunities. But also for a lot of other people who I speak with, there's nothing to do. There's nothing to plan for because in general, your tax situation in the U.S. could be much easier once you're moving to Ireland. Now, overall, it's going to be more complex because you're going to have to deal with Irish taxes, and that's where things are going to get complex. But in the U.S., it might be easier. So sometimes I'll speak with someone who's very worried and wants to plan and wants to know exactly what they're going to pay. Just in general, this isn't special to Ireland, but when someone wants tax planning, I might say, okay, well, how are your decisions going to change if for example, how much you're going to pay next year? They want to know how much they're going to owe in taxes. I go, well, are you going to, do you have enough money in the account to pay either way? And maybe they do. So it wouldn't change anything if they know how much they're going to pay. Other times it is very important. Maybe they're not going to have the money, so they need to sell stocks and shares to make sure to have that money available. Or based on the amount they need, they're going to owe in the U.S. and Ireland, they're going to make a lot of other different decisions. So I think that that's going to help determine what type of planning is necessary. But there are lots. I wouldn't say everybody moving to Ireland needs U.S. I would recommend everybody speak with an Irish tax advisor about what you need to know there, because you want to be off on the right foot once you move. But from the U.S. side, some people it can be very important. Other times it's something that we would deal with from your first tax return. So you move to Ireland. Once it comes time, February, March, we would have a call and then determine, what you need to do for the year and the best way to file. And tax planning wouldn't be as important.
That's what we see happening quite a lot, really, isn't it? That clients will come to us, we'll have a discussion with them, and then we'll say, okay, talk to Josh or talk to Josh's team, or, basically consider how the US position changes. That is generally how it will work. So if we were to look at the majority of people, we speak to them, we do a consultation, we do the Irish piece, we'll loop you in so you can have a chat if needed. And then when we come to do the tax return, we're doing the Irish return early. We're giving it to you as you need it to file in the US with respect to whatever deadline's in play. And then behind the scenes, we essentially just coordinate between us, don't we? It's in other words, most clients don't really want to know what's going on as long as they know that it's actually done correctly and that there's experts dealing with it for them.
Yeah, for sure.
Josh, if people want to have a chat with you, we will put your contact details in the show notes, but just talk a little bit about what working with you and the team looks like. How do people deal with you? Tell us your contact details, et cetera, et cetera. How would you like people to make contact with you as a result of this discussion?
Sure. Yeah, you can email me directly at josh@universaltaxprofessionals.com. Usually we're able to set up a quick 15-minute introductory consultation. The purpose of that is going to be discuss our services, discuss your situation a little bit. In that time, I'm not usually able to give tax advice or go deep into your tax situation, but definitely discuss how the process could work and give what we'd recommend, or possibly that could be the beginning of our relationship, and we might be able to work on planning from that point, or filing a tax return. We have a team of about 15 accountants. So usually, if it's tax filing season and you want us to help with your tax return, we would then send you everything we would need, including our new client questionnaire, and then pair you with an accountant, and that would be your main contact who you'd be able to email and speak with directly with any questions. We have a great team. Our accountants are great. We have 2 tax directors who are fantastic, and we love our clients from Ireland and who we share as well.
Yeah, we've got some really good ones together. Josh, this has been really, really useful. It's really nice to actually sit down and go through these things and solidify how the process works, and what people are doing day to day, and how it's working out. And yeah, I've no doubt people will get a lot of value from listening to your insights. So thank you so much for taking the time to share them.
Thank you so much for having me.
It's been a pleasure. It's a pleasure working with you guys. And yeah, I'm sure we will definitely have you on in future. There's plenty more to talk to, but I think we've done a really good job of kind of hitting those key points today. So thank you very much.
Thanks for listening to Tax Bites for Expats. Please do leave a rating or review wherever you listen to your podcast. And as always, remember to take professional tax advice specific to your personal circumstances before acting or refraining from action in connection with the matters dealt with in this series. The material in this podcast is intended to give general guidance only.